Yes, let's do claims first because not a lot of change here. It was 212,000 last week. This week, 217, so a slight increase, but nothing that's going to tell Jay Powell that the labor market has gotten particularly looser. The productivity numbers are really interesting.
Yes.
Non-farm productivity in the third quarter up 4.7%. That follows a 3.5% rise. Now, this is with all the strong hiring that we've been doing, so it does suggest that the economy is able to withstand high interest rates and the inflation rate where it is. And this is the kind of thing we haven't seen basically since the 1990s. Now, that raises the whole question of where you go from here. But unit labor costs only up 0.8 of a, actually, I'm not seeing the minus sign. Unit labor costs fell 0.8% after rising 3.2% in the prior quarter. So businesses' margins should be okay. They can afford to pay us, and we're doing more work in return. So this is the good news.
I'm sorry. Julia Coronado's onto something here, Mike, which is possibly we have a gross misperception of advancing productivity or efficiency in America. How does this change the dialogue, Mike, in your world if we see good and better productivity?
Well, it obviously sets us up for a different kind of monetary policy going forward, and for the fact that we can afford to have the kind of wage gains that we have been seeing. And it's less of an inflation danger than the Fed would think. Now, this is 2 quarters where we've seen some really strong growth. Normally what happens when you see a productivity jump is you're coming out of recession and there are fewer workers, but they have to do more work. In this case, we're long out of the recession, and we've been hiring like crazy, so there's lots of workers out there, and they're just able to produce more. Is this the beginning of the AI trend as well, like the 1990s was computers? So a lot of questions out there about how long this can last and then what it would mean going forward.
So how does this set us up for the jobs report on Friday, Mike, where the non-farm payrolls, according to economists, surveyed by Bloomberg, expect 180,000 jobs added after 336 jobs added the previous month?
Yeah, well, we were all stunned by last month's numbers. I don't know that we'll get the same kind of surprise this time, but you can't rule it out. But 180,000 is still quite strong. The Fed thinks you need about 100,000 to absorb new entrants to the labor force, and they would be looking for a number around that level to suggest that the labor market is no longer tight. But right now, with jolts where they are and with the numbers that we have seen in many other indicators, including jobless claims today, you have to think that hiring remains strong. And Jay Powell was asked about this yesterday. The labor market is not reacting the way they expected it to. Nothing really is these days, but they can't really take the same kind of clues from it that they thought they could when they were originally raising rates and trying to figure out where they needed to go.
How do you read the unit labor costs? Because I was surprised, too, by that negative sign in front of the 0.8%. This is an unexpected decline in the third quarter, and these are preliminary numbers of unit labor costs, down 0.8%. The consensus estimate was for a gain of 0.3%. What does that mean when it comes to the real economy?
Well, if it is really that unit labor costs are falling, it's kind of hard to believe in the sense that we're seeing nothing but rising wage levels. But the unit labor costs can be a little bit volatile because a lot goes into it besides just wages.
Gotcha.
The other costs of running a business. But if they do, if they are lower, then obviously companies' margins can be higher and they can afford to raise wages, which is, of course, all very interesting in the context of the UAW settlements.